Alright, well, it's recording. We're going to see what happens. If it comes out good, and yay. If not, then we'll figure out something else. Okay, so, Chapter 5. This was probably the longest definition chapter that we did. And it's all about fraud, internal controls, and cash. And so I would probably expect quite a bit of multiple choice, but there is two main items that come from this chapter, and that's going to be the bank reconciliation and cash budget. So both of those are going to appear. So starting off with fraud, and the main fraud item that we always have is, of course, the fraud triangle. And the fraud triangle does basically give us an idea of what needs to be present in order for an unethical action to happen. And again, there has to be rationalization, where again, we're going to basically convince ourselves that it is justified to do what we're doing. We may have financial pressure, like unpaid bills, that makes us want to commit fraud, especially in this time and age right now. So a lot of financial pressure going on. And then of course, the opportunity, where we believe that we're not going to get caught. And if anybody's ever watched American Greed or Forensic Files, they're going to get caught. Don't do it. Because you already knew what's going to happen when you do. Go to jail, I use my skills, I find you, I go up there, I teach you something, and then what do I smack you with? Yeah, no. For Arnold, I'm going to smack him with the rubber chicken and the chocolate. Really wants another item. Anyway. So, with fraud, businesses have developed something to help protect them. And when they did, these became basically known as internal controls, because these are handled internally, are basically with the business. And again, they're supposed to be providing different items to help achieve objectives for the business in relating to operations reporting and compliance. Definitely compliance with the government. So, they have basically 5 primary components. And again, if you have your notes, you can look at these 2 and they're basically uncovered. So again, probably expect a multiple choice question that's going to ask you which one of these is like part of the components or something like that. You know how they run. Anyway, so the first component again is the control environment. Well, the responsibility of management is to make clear that the organization values of integrity and unethical activities will not be tolerated unless it's by them. Then it will be, because they're boss. Kidding. Nobody is above the law. So, management has to be an example that there should be integrity and no unethical activities. And yes, they want to make an example of someone, they will. So, you punching in your friend early and basically costing the company time, they can pursue you to the law. Remember, you get 20 years for punching someone in 1 minute early. That's how much fraud is taken care of these days. Next, we do have the risk assessment. And this is where the company will go around and basically identify and analyze various factors that could possibly be potential for risk. So if their computer system is vulnerable, if somehow people can just walk into the building and walk out without nobody knowing, which was going on with schools for a while, which was crazy. They're going to figure out ways to help manage these types of risks. Right now, we see a prime example with the government trying to prevent the risk of COVID to spread. And when it doesn't work, they think of another way. Thus, why we're now required to wear masks when we go out. Because you still need to get stuff. But that's the thing. They're analyzing and they're trying to identify what's still creating the spread. We do have control activities. That's number 3. And these are again design policies and procedures to address the specific risk. Okay? And again, they want to reduce the occurrence of fraud. So now we assess the risk. We're going to look at controlling it. Okay. From controlling, we're going to provide information communication. So we're going to basically communicate all information, and this is going to go both down and up in the organization, as well as communicate information to the appropriate external parties. Again, businesses are going to go through everything, they're going to analyze, and then they're going to basically communicate what's going on. And then the last basic step, because these are pretty much steps anyway, is monitoring.
Do you want some more? No.
Again, if your mic's on, you may want to mute it, okay? Just being so that it doesn't cut off our mics. So monitoring is going to be the last step, and then of course it goes back to the cycle if something's going wrong. Now, with the components, we also have principles. These principles are basically different ways we can use internal controls to help prevent fraud. First 2 are pretty much common sense. One is to definitely establish responsibilities. Again, you want to let people know this is your job, this is what you're supposed to do, clearly, no ambiguous items, and make sure things are assigned to one person. If you got a person that's doing multiple items, multiple things, and they don't know what they're doing, there's more likely a chance that they're going to either make a mistake or let someone in that they shouldn't. And it happens. Next, again, is segregation of duties. And if you have one department and you have multiple people working or multiple people in a company, or you want to make sure that the duties are basically segregated in the process. You don't want to have anybody with too much control over any one process. And that's basically what segregation is doing. It wants to be having different individuals being responsible for related activities. Meaning, basically in an accounting world, you want somebody just to handle the receipt of cash, basically getting cash in, one person writing journal entries, one person writing the checks, so forth and so on. Again, you want to try and break up the process so that, again, the person that's receiving the money doesn't also make deposits. But again, they can say, well, this is how much actually came, and pocket some others. Again, no one gives an opportunity to people. Again, that's what 2 is going with. The responsibility of record keeping for an asset should be separate from the physical custody of that asset. Okay? So, again, we definitely want to make sure during the process nobody has too much control, or they do not have that opportunity to commit fraud. Again, it's easier for larger companies, and small businesses it's harder. This is why in a small business, the owner should be able to take charge, should understand what's going on in the business. Don't trust anybody. That's usually what an owner should do in a small business. I know it sounds bad, but things happen. Remember, I told you about the client that they had a family member steal $400,000 from them. I mean, just how it goes. So, next, we do have document procedures. Usually, a good component of internal controls is to have pre-numbered documents for any physical document that is going to be moved around in the company or going out externally. This also means have a couple copies. This is why a lot of companies use the carbon copies from time to time. So, pre-numbered documents are best too. Again, it lets you know what's going on if something's missing or it skips a number. Where is that document? So, also a good way to make sure items are timely recorded. Next is probably the one that we all see. Again, this is the physical controls. These are basically there to safeguard assets and give that sense of security. Now, it may not always work, may have some glitch, but again, if people see it, they tend to not want to commit something because they are afraid of getting caught. So again, those common ones are, of course, safes, locks, maybe a password on a computer to even mount fingerprint, alarms. You see any kind of security system. It helps reduce the risk of break-ins. Not always, but again, if somebody sees it, they know probably not to mess with it. The good old spider wraps or garment fixers. Again, ensure that theft. And of course, time clocks for recording employee time worked. Okay. Next component that we would have is independent internal verification. And these, of course, having people basically either outside of the company, external auditors, or people that are actually known as internal auditors. Their job is to be separate from everybody. They're kind of like the lonely man on the island playing with the volleyball and going and name it Spalding because they got the wrong time. But these guys basically will come in and they will audit and make sure, one, internal controls are going, two, that there's no fraud. Their job to basically make sure of that on the accounting side. But it's always good to do this on a surprise basis. Again, surprise basis usually will get someone that's trying to commit fraud to be basically looking over their shoulder, wondering when the next audit's going to happen. Eventually, they're going to make a mistake, and people do. This is also why we make people take vacations. Because again, the way to audit and see if there's any suspicious activity. Discrepancies and exceptions should be reported to the management level and the correct management level. If somehow an auditor finds out, if somebody finds out that the manager or production manager that's causing the item, you may want to go to the regional manager, so forth and so on. Remember, you want a job. Companies don't have a heart. They are there to only make a profit. If they can't make a profit, they close down. That's what we're seeing right now. Small businesses have to take out loans and whatnot to keep open, basically keep paying their workforce. If not, they're going to go and be furloughed or laid off. So, companies are trying to survive. Again, nobody's prepared for this kind of item. And insurance companies are fighting because they don't want to pay the policies. It's a crazy world. The last item is, of course, human resource controls. These controls are simply, one, if anybody that's handling cash, you want to take basically insurance protection on them. This is known as bonded employees. And guess what? Accountants tend to be bonded employees because we're the ones handling cash the most. But this is just in case, again, fraud happens. If fraud happens, then, and we can't recover the cash, insurance does pay for their policy how much cash that we get back. Again, the best way that also helps is the banks. Banks are really good at doing that. Sorry. I'm saying, I'm learning this technology and I just realized I had a message on the line. I make sure I have my phone looking. Firstly, firstly back, firstly jitters. Anyway, number 2, again, we want to rotate employees' duties and require employees to take vacations. That's always good. Don't want to burn out your accounting department. Conduct thorough background checks. Seems a little bit common sense, but when some people just go, hey, you're an accountant, cool, you're hired, and they don't do a background check, they don't know. That person may commit fraud. I mean, think about it. If you want to take something famous, you ever watch the movie Selena, which the person that they hired for their accounting actually had in their background a settlement because she committed fraud before she got hired by Selena. And if they did a thorough background check, what would have happened? Well, she probably would have got the job, she probably would, but that's hearsay. Either way, first you on now. Alright, so what ends up happening when internal controls are not met and fraud does happen? The government will come in and basically take control, or basically tell companies what to do. And again, in the great time of the 2000s, when internet companies were closing down and the big bad frauds of Enron and WorldCom happened, the government thought, y'all don't know how to audit. So, they come up with what is known as the Sarbanes-Oxley Act, and it was named after, of course, senators that came up with it, are basically SOX. Okay? That's how we call it. They're trying to talk it to us, it didn't work. But either way, this is basically saying that all companies that are on the stock exchange or stock that is traded on basically traded corporations, that they must document internal controls. They need to make sure they're effective. In order to be effective, they have to be evaluated by auditors. Auditors will come mostly from the government, from the SEC, and they are going to make sure everything's kosher with your controls. If not, you're not allowed to trade your stock until they are. Again, they're there to protect the individual. They also allow the establishment of the Public Company Accounting Oversight Board, or the PCAOB. Now, again, that Oversight Board now creates the auditing standards that we know of. And if you are going to be an accountant and you want to be an auditor, make the big buku money that auditors can, the CPAs and whatnot, then that's going to be the place for you. Okay? I mean, you're going to have to know the auditing, you're going to have to take an audit class, and basically you learn the standards. But overall, government came in, they did this, and again, they had to do it again for 2008, because again, that was the mortgage housing, and that was the Frank Dobbs Act, Consumer Protection Act, basically Frank Dobbs Consumer Protection Act. But these will happen. Mostly it's there to, again, protect and keep the economy going. Right now we have stimulus checks, and I think it's called the CARE Act, but that one doesn't affect really accounting. It's just there to help us in this time of need. So, limitations. Again, biggest limitation of internal control is, of course, us. Where's the number one cause of internal control failure? That could be through error or fraud. We want to, again, somebody's worked in the same company for 20 years, you never change your internal controls. Of course, that person's going to know every way of defeating it. And again, gives them more of an opportunity. Same thing in collusion, when multiple people want to come together and commit fraud. It happens. Again, internal controls are there to basically, again, protect, but they cannot completely prevent. Okay? They're there for show most of the time. But again, that's their job, is to basically deter anybody from doing it, but again, they cannot completely prevent it. And the other item, usually cost benefit. Remember, companies are there to make money. And if the cost is more for internal control to protect very little in assets, there's no benefit to that internal control, so they're not going to use it. Yes, it leaves them open for losses, but again, they have to raise the cost. That's why, again, when there's very levels of security cameras out there, most convenience stores will probably pick out a lower quality security camera because all they have as assets is very cheap items, food, and hopefully not as much money in a cash register. But when you look at Walmart's got a huge store, and they have lots of high-end items. So of course their security camera and security system is a lot more sophisticated and better quality. So things have to kind of work out on those items. So that's a big concern. So I'm going to stop here and ask John real quick. Does anyone have any questions? Again, if you do, type it in the chat. If you do not, type in no. Okay? So again, it lets me know everybody's listening. So any questions whatsoever over what I just went over? Again, most of this is going to be multiple choice. Don't worry, it won't be a workout problem because there's nothing to work out on. It's just, again, knowing the differences in the items. So again, have all three of the notes open when you do the exam, and you'll be fine. I'm okay with it. Okay? Alright. Now, the main attraction of this chapter is dealing with cash. Cash money. Money, money, money. Money. Anyway, so basic definition for cash as accountants. This includes anything that is known as currency, coins, and deposits in bank accounts. So this does mean we consider also credit cards as cash, since that's immediately a deposit, usually in our bank account. We also include items such as checks, and more checks, customer, cashiers, and certified. And of course, some good old-fashioned money orders. Anybody still uses money orders? And it's still done, but I don't see it as often. Usually money orders are done by people that call you up saying that they're the IRS and demanding money right now. And they use gift cards. Anyway, if anybody actually calls you on and do that, just mess with them for a little while. And do that. Just like, I know. Don't mess with them. Just have fun with them. And they're eventually stop. Everybody thinks quick, rich schemes. The other part of cash, though, is also what we call cash equivalents. And these are short-term, highly liquid investments. It mostly means this. They're very easy to be converted into cash. So these are like CDs, savings accounts, we got stocks, something that we can basically sell off very quickly. And again, they're mostly going to be close to maturity date if there are bonds, like a treasury bill, or any of those, and usually within 3 months of maturity. This means that interest rates are not going to change too much. And usually treasury bonds are typically the ones that kind of be part of cash equivalents. Again, the government not going to go bankrupt. They are going to be basically paying off that bond, and you can sell it very quick because people know how security treasury bills are. So, again, if y'all remember, when we talk about cash or any asset, a lot of times we do talk about liquidity. And again, this is the ability for us to meet our current liabilities. So liquidity really deals with mostly current assets. Now, this means fixed assets, which is long term, are always under these. And honestly, it doesn't matter how you arrange a fixed asset. You can put buildings and then equipment or equipment to buildings. But when it comes to current assets, there is an order. Okay? Always have to remember this. They're in the order of liquidity. Okay? Or basically, again, how quickly can we convert it into cash to pay those current liabilities? And the number one item that can be converted into cash is, of course, cash. It's already cash, so don't have to do much. The example that we have for Delta does show this. They show short-term investments. Again, items we can really easily convert to cash. And then, of course, restricted cash. Now, this is still cash, yes, but it's not as easily to be liquidated as regular cash. Reason why is that restricted cash is only available for special purposes. Again, this is to set aside for future liabilities or expenses, such as lawsuits. Lawsuits, number one, especially if we know our product is not all that well. But future liabilities do include a sales tax. You want to set aside and restrict that cash because, again, that's not your money. That's the government's money. So you don't want to go ahead and spend it, or you won't be in trouble. Same thing that ends up happening when a company estimates its income tax return. When they do, they want to restrict that cash in case they run out of money, just so that they don't overspend. So, again, this chapter will go through basically how we receive cash receipts, and how we pay cash. So, cash receipts model is basically the internal controls. As you can see, here's all the controls from our chart up here, all 6. And they're basically showing you how each of those controls, those principles, are used in the receipt process. Again, first thing is establish a responsibility. We only want certain people handling cash registers. They're probably people that we trust. We don't want multiple people handling the same cash register. If you have multiple people with the same and one login happening on, you cannot tell who may be pocketing some money. Again, and this is why you don't leave If you have a cash register, leave it logged in under you. And again, next person, they could take a little bit of money, and then you're laying for it because you're the login person. So, also, you want to establish who actually handles the money. So, that's the biggest issue. So when this happens, again, we have segregation of duties with cash receipts. Cash comes in. You want people to basically handle receiving of cash and the cashiers, people that are going to record the cash receipts, and finally people that actually get to hold the cash. Okay? Again, you want a process of this where not one person can control all of it. Because again, they can basically say some items and say that the system is wrong. Okay? You want to make sure everything's documented. So this is why we have cash register tape. Looking at retail, but we have computer records, we have deposit slips, we have pretty much any kind of documentation to show that money has been arrived or a check has been received, and in duplicate. We have our physical controls. Again, most companies are going to have a safe right there on the premises to help store the money. They're going to have only, again, this is part of establishing responsibility and segregation of duties. Only certain people will have access to the safe, usually a manager. And of course, we have our cash registers, which is a good physical control, our point of sale terminals. Next, we usually have somebody that's going to verify. So even though, or take an example, retail, the manager does make a deposit slip and deposit the money, the corporation is still going to have somebody independent to verify and wonder, why is the money always short than what the register tape is? Well, why is it more this time? There are going to be some people that are going to verify all the time with all these different outlets. Again, that's their job. And again, we're going to compare a lot to this. This is also where the bank comes in when they receive your deposit bag, and the money that's in the deposit bag doesn't match your deposit slip. What's going on? And of course, you got human resource controls. We want to again bond anybody that handles cash or have an insurance policy just in case, those vacations, and background checks. I like how they have this guy thinking. He's either thinking, ooh, I'm going to have a nice vacation. Or, crud, I'm going to find out I'm going to jail. Not good. The strings that these dots look like patent dots. Anyway. So, that's basically cash receipt controls. And again, this is your basic breakdown using these controls into different areas. You love pictures in this chapter so much. And this is showing starting off with two different items. Of course, you have the clerk. If you ever worked retail or fast food, you have your register. I like how they have the new fancy touchscreen register. That is awesome. Some companies doesn't even have that. In fact, I still remember at Arby's here, it had an old school technology only upgraded. That old school was crazy. Anyway, they're going to enter sales data, and sometimes they're going to count the cash to make sure that they put in the correct cells. They're going to send cash and count the cashier. Cashier, which we already technically call this person the cashier, but there's another type and more of a term. This typical cashier would count the cash and prepare the deposit slip. Usually that may be a shift leader. Sometimes we call them those. On the other side, the supervisor comes in and they're going to look at the register tape or remove it from the register. They're going to send the cash register tape of the documentation of what happened to the accounting department. The accounting department's going to receive that. Meanwhile, the cashier makes the deposit slip and is going to send a copy of that to the accountant. They're going to have a deposit slip to the bank with the cash. So the bank's going to receive it. The accounting department's going to receive it. They're going to verify. It's like a really big corporation. But they're going to verify one tape of the deposit slip matches, and then they're going to actually verify everything with the bank. That's what we're going to get into in a bank reconciliation. Again, just know the process a little bit. Multiple choice on these. Nothing too big. But during, again, this process, it's our first kind of journal entry that we have going on. I think in this chapter, I was experimenting just having these and not like fill-in items. So, I remember the good old days, like almost 2 months since we did chapter 5. But during this process, again, sometimes the register, there's sometimes no explanation, can become over or short. The promise one on this is that it should be a very small amount that happens. That's why we use cash over and short. Again, either customer says keep the change, or somehow the clerk, the person running the register, accidentally gave out some money. Relatively pretty much closely to just a little bit off. Now, if it does become very material, or there's a trend, especially if one shift is always like that, then we should investigate. But if this does happen, and during the reconciliation process with the accounting department, which gets the tape and the deposit, we may end up making a little journal entry to show that somehow, yeah, the cash register is off. Okay? Why is it off? Well, I mean, something happened. It's either over or it's going to be short. So we look at the comparison between the day's sales and how much cash is received or received. So those two numbers are always going to be given to you. So again, those two items happen. One, the register is going to show sales. It's going to show fees, which is nice. And then it's going to show you how much cash was that came in. So again, we know our cash, we can put our cash down, and we know our revenue. Problem is, as you can see, they do not match. They match that everything's good, it's a perfect world, hey, but they don't. So when this happens, you need to find the difference. Okay? And this difference is going to affect one account. Again, this account is known as cash over and short. Okay? So basically, what happens to our cash? Is it less or more? If it's less than your revenue, you already know it's going to be negative. Because again, we didn't receive all the cash. It is short. Okay? If the cash is more than revenue, then the cash is over. Okay? So this would end up becoming a positive. Runs through the same account. Okay? Cash over and short. Again, that's just basically the difference of these two numbers. So when we do it, always take the calculator. Can you guys see the calculator? Just want to make sure. I'll jump in it. Okay, cool. Just want to make sure that you can see it. Because that way, once I pop it up, I can see actually do the math. So, always do this with cash over and short. Always take your cash and subtract out the revenue. This will also help you what you're going to put in expense. So it's negative 10.10. Mine doesn't do two decimal places. So, mine's a 0. But, that shows me there, cash is short. And if somehow, say this, cash came in, and it was 6,900, let's say, so cash came in like this, I subtract out the revenue, cash is over now. Okay? Now it's a positive number. We got more money in than what we actually did in sales. That's really all that's going on with cash over and short. Just comparison. Okay? Any questions on this one? Again, this one's like one little smaller item that's in this chapter. Alright. So, when we're starting to get money in or dispersed, and one, you get money coming in through mail, one, never tell a customer to send in cash through mail. That's why we have checks and money orders. So you shouldn't see cash. Again, there's no guarantee cash will ever get to you, especially through the post office. So when you receive any payments through the mail, which now most of the time through electronics anyway, but we should have at least 2 mail clerks. Again, this could be 2 regular employees, and this is just part of their responsibility. At least 2 different people to basically check to make sure these checks came in. One, we're going to always endorse checks, and if you've ever seen a check, this is on the back side, where you would sign it. You want to endorse it for deposit only. Again, this prevents somebody to actually cash the check, because the bank can only deposit due to the endorsement. And of course, create a list of checks received each day that the mail clerk will sign over, saying that, hey, yes, we checked it. These are the checks that came in. No, this check hasn't come in yet, or something like that. Again, these lists will have basically, as in triplicate, means there's 3 copies. The original with the checks will go to the cashier, just like deposit slip. The copy will be sent to the accounting department so we can verify. And then, of course, clerks will keep a copy of their own. Sometimes customers will accidentally send 2 checks for the same payment. So they have to be aware of that happening so they don't accidentally cash and double charge. That happens more often than you think. So, that's all about receipts. Next part is, of course, disbursements. And a cash disbursement in itself is, again, us paying a liability, paying someone. And again, they have their 6 items of internal controls. And of course, responsibility is only certain people are authorized to sign checks. Okay? And it probably approves certain vendors. And you don't want somebody's uncle twice removed that they're very familiar with somehow be the vendor that leads to some ethical issues. Also, don't have an actual signature stamp. Okay? Signature stamp for checks and just that getting out can cause lots of trouble. Again, segregation of duties. Make sure you have, again, individuals that are able to make payments. You have your check signers, and none of them record any of these disbursements. Keep it separated. Have pre-numbered checks for document procedures. Make sure everything has an invoice. And make sure if there's a credit card that it's limited to who has it. And again, you have documentation. Fiscal control, again, if you do have blank checks, probably store them in a safe and keep access away from people. And again, we'll run verification. This is, again, reconciled bank statement. Or basically make sure every check has an invoice that goes out. And of course, human resources, the same thing. On people that have no cash, vacations, and conduct background checks because they don't want to go to jail. So this is the shattering figure that they see on the other side, that they know who that is, without to smack them with something. And that's what people think of. Sounds are really like a Chuck Norris of fraud. I'm going to come after you. So, the ways that we use these, again, I've already talked about pre-numbered checks and physical checks being limited. A big system that works with these documentation is what we know as the Voucher System. And all the Voucher System is comparing contrast, making sure everything has the proper documentation. And we vouch it before we approve it for the next step. So, a lot of times, us as accountants will go through and make sure that everything is correct on every document. Okay? Making sure before the payment is actually sent. So again, this is a very simplistic one. Again, there's a lot more to it. But from the purchasing request, whichever department's requesting, we'll go through, we'll create a purchase order, make sure vendor gets it to understand, and make sure all numbers in request is correct. Then we move to the invoice, receipt from the supplier, make sure the supplier's charging us the right. Also, we'll probably have a receiving report for shipping. Again, little slip that comes in the packaging to if it's just us as individuals, or if it's a company, they will have a receiving report that should match again the invoice and purchasing order. Then, if everything's good, from the receiving invoice, we usually send out approval to the cashier to basically write the check. But all it is basically comparing and making sure everything is correct. And again, back in the good old days, this used to be just bunches and bunches of file cabinets. A lot of paper wasted. Nowadays, this is all done on computers, through QuickBooks, or any other item. Mostly electronic source now. Makes life a little bit easier. But yeah, we do have to keep track of all these documentations as we move forward through the process. So this is why internal accountants, or basically industry accountants, get paid by their money. They do a lot. How can we do? Now, when we make tiny little amounts of cash, this is the only time that we're probably not going to write a check. And the reason why is, again, these are small, insignificant amounts. This is your shipping fee, probably buying stamps, that's really what it is. Maybe small repairs, low-cost supplies, making the office depot run, maybe getting snacks for the office, the donuts, the kolaches. Oh, kolaches. Oh. Anyway. When these small payments come, we get the good old-fashioned petty cash. Okay? Again, petty just is a form of small, insignificant, very petty. But petty cash is, again, a small account that usually only holds maybe $200 to $500 at one time. Not going to be material, because again, if you have a material item, people want to take it. But we always set it up with a small amount, and when a cash payment is made out, petty cash, some companies do have receipts, basically they're pre-numbered, and this is easy to go to Walmart and pick up one of those little booklets. But this lets us know and track employees that do take money and make sure that they pay it back. Any change, which most likely does not happen, and since it's insignificant to the company, they're probably just going to pay. Usually if it's like only like you're getting 20 cents back or something like that, then yeah, they're not going to be worried about it. But they do want to keep track and see if why is one employee always going to Office Depot. Maybe we should actually bulk order the supplies. But either way, it's just questioning and managerial decisions. Pay cash is also usually replenished only at the end of accounting periods or when it's almost zero. We don't replenish when it's like mid-month, it's only like maybe a fourth used, makes no sense. So they only replenish it at the end of the accounting period, or again at zero. Amounts spent, again, are recorded as expenses related to the payment and a credit to cash. Again, yes, it's lowering our petty cash amount, but we keep it as expense and a credit to cash. Once we replenish it, that's coming from our cash account to back to petty cash. So I'm not going to go any like major petty cash generalization to y'all or tattlers. Book doesn't even do that. So don't worry about actually knowing how to do this. You get to learn this probably when you're actually on the job site. But because if you're just doing Lone Star, I don't think this is actually covered in 1201. But there's probably a class. I don't know all the classes in Lone Star, so you probably will see the petty cash system again. Fine. But again, all I really want you to know is what it is and basic definitions. Alright. So I'm going to stop right here. Any questions so far before I get into the bank statement? Alright. Okay. Well, let's keep going. Alright. Banks. Banks. Things that are there to help secure. That's their main job, is to basically secure our money, even though they use it for their own personal gain. But they're there to, again, safeguard and make sure that our money is safe. And a lot of times they have physical items like bank safe, or security, and of course those digital defenses. But there's certain other items that the bank will have. And starting out first, of course, the good old bank accounts. This is just a record of knowing it for us, and when the money is deposited, and it also controls our withdrawals, especially when we look at savings accounts. So, remember, if you work at certain banks or have a bank account, when you deal with a savings account, they limited you to maybe 6 withdrawals a month before they start charging you a fee. Next item that banks typically help is known as signature cards. Again, anytime a bank account is open with companies or nonprofits or any other item on those accounts, the bank is probably going to make anybody that's authorized to write checks or make deposits to provide a signature card, which is basically their signature so that the bank can verify to make sure no fraudulent or somebody basically taking an identity theft is taking out money that they shouldn't. And again, a lot of banks will have a personnel that actually does verify signatures at times. Again, they're not perfect, they're not a forensic person, but they're running very close. Next item that we usually have for banks to help with money, of course, again, what we've already mentioned, the deposit tickets or deposit slip. And these are complete with every cash deposit. And again, this is our proof that deposit has been made and keeps everything reconciled. Okay. Checks, we already know about checks. Again, these are basically what a bank or what a company is going to use to make payments. And so I take these checks and make the withdrawals. If you spin them off since you wrote a check, there's usually 3 parties to a check. Of course, that's the maker who signs the check, the payee, who's the recipient, and of course the payer, which is basically the person that signs the check and which account that it's going to be drawn from. Next is the one that ends up having the most fraud and what banks are really there to protect you from a lot more is of course the electronic funds transfer. And these are basically known on bank payments as EFT payments. I see EFT quite a bit. Again, these are payments made from your debit card and are made electronically off websites, all those fun little items. Again, this provides customers a good convenience. And it's typically low cost. Allows less people to handle the items because it's been done electronically. Again, mostly a lot of banks do have fraud departments. And if they see something funky going on with your bank account, like somehow you did a payment to, I don't know, let's go Harrington's in London, and you know you're definitely not in London, the bank knows you're not in London, they're probably going to call you up and go, hey, did you make this payment, or did you use your card here? And of course you're going to tell them no, because you wish you were in London. But we do have the banks coming in to help us out on those items. And of course, the last thing that we're going to be using in this course is, of course, bank statements. These bank statements do show all activity in the account, and they're usually prepared monthly. Okay, maybe a few days off from the end of the month, but they are performed every month. And again, we typically reconcile these in a timely manner. Mostly if you're going to be a bookkeeper, this is mainly your job, is that you're going to receive bank statements and you're going to make basically a reconciliation based on these. You're going to verify everything in that bank statement is correct. Okay? And we're going to find out stuff that's due to a timing issue that is going to be a little bit off. So, again, we're going to be checking those items. Okay. So this is going to lead us to the main issue of, again, Chapter 7. We have internal controls, cash, and the big thing that's probably going to be your workout problem of bank reconciliation. So, what we need to do is really find differences between the bank and the records. Why is one thing recorded on one and not the other? Okay? That's really what's going on. A lot of times, again, this is going to be a timing issue. And pretty much it's going to be happening at the end of the month, and it's going to most of the time deal with the bank. But folks have their own timing stuff. Okay? And of course we do have errors. We are human. We do mark down or basically write down numbers sometimes a little bit off. We flip numbers by accident, not knowing it. And most of the time they're actually the middle numbers. Go figure. So when we look at these, this is the basic formula. Okay? We're going to go over this again in an example. And when you look at these, one, we have the bank, and we have the book. And there's typically two main timing issues for the bank. One is known as deposits in transit. Okay? These are deposits that have been made into the bank and the book has recorded. So now we have one place that recorded it, the other one has not by the end of the bank statement. Most likely these are going to be ones that are done at the end of the month, usually the last day. And again, bank statement is printed on the last day of the month. There's no way that deposit's ever going to be there. Okay? The other timing issue that typically happens, known as outstanding checks. Okay? Now, outstanding checks in themselves are checks written, and again, we have already recorded them in our records. Again, due to our principles, we must recognize all expenses. But they have not cleared the bank or became canceled checks. Sometimes that term is used. So, when that happens, the bank is off just a little bit compared to our books. They have yet to record this expense in our bank account. So we must subtract these out. Okay? Again, we know how cash is handled. A deposit, our cash is going up in a bank account. We got paid. A lot of times you want to think about that way. Paycheck came in. And then, of course, any checks will lower your bank account, got to pay the bills. So these are ones that have yet to clear, or basically show up on the bank statement. But they're going to do the same effect. Again, a company definitely wants to make sure that, especially for outstanding checks, that they have enough money in the bank account to pay this check once the person actually decides to cash it. So, this could be, I don't know, maybe a check that can be done only off by the end of the month, like payroll payment at the end, or it could even be somebody that had it for 6 months. Eventually it's going to get cashed. If it doesn't and ends up being voided, then we make the proper adjustments, but we're not going to get into those parts. It's a little bit above our pay grade. All I want you to do is understand how the basics work. So, again, we have bank errors, and eventually it will come out to the adjusted cash balance. Okay? On the book side, book tends to be a little bit easier, and it's simple. When you look at these are stuff that the bank has done, but we didn't record it yet. Most of the bank did it without our knowledge, usually what's happened. Typical is collections. Okay? This is where we had probably an account that automatically the bank is allowed to collect for us, or a note that runs through the bank, and they collect money on our behalf from customers. Okay? They do that as something that we didn't know. So at the time of the bank statement, we're going to look at these extra deposits and add accordingly to our cash on our books. Another typical one that only shows up at the end of the month is if the bank pays us interest. So this is your CDs, your savings account, so forth, so on. If they pay us interest, then yay, you got money. Woo-hoo. So, again, we won't know about the interest till the end of the month anyway, once the statement comes to us. Other items is, of course, bank fees. We won't know a bank fee came to us till the end of the month. They're going to be pretty much simple fees, probably just maybe a bank statement printing, account charge, or check printing. Usually there's a typical bank fee. We also have the good old NSF checks. And boy, do companies hate these. So of course, these are non-sufficient funds. And those checks basically say that customers check bounced. So in our books, currently, we show it as a increase in our cash balance because we made a deposit that had that check. Turns out the bank couldn't clear it, or basically make that deposit due to that check bouncing from the customer. So they basically will write down the accounts, so we need to do the same. But the bank also charges a fee to that. So, yay. So we have to pay back the check and the fee, basically what's going on. Of course, we're going to charge our customer that amount of money. Because one, they made us angry. They did not like us when we're angry. We smash. But we charge them a fee and basically make sure that they pay us the money. And we're probably going to tell them pay us in a money order, not a check anymore. But that's a managerial decision. We're not going to get into that kind of hearsay. And I will say this also, there's going to be book errors. More likely than not, an error, be it the bank or the book, will probably favor the book side. Okay? So if you do have a problem with a error, probably just take a shot in the dark and probably think it's going to be on the book. Typically, we're going to write it down erroneously in the records, bank data actually clear. Now, again, that doesn't mean that the bank is perfect. Bank will make errors. But most likely for this class, probably going to be the book. On time, like 8 out of 10 will be the book. Alright. So, if you've never looked at your bank statement, we're going to look at one. And we're going to use this to help in the reconciliation process. So, National Bank and Trust in itself. One, bank statements are this. We'll always have the bank. And if you're getting a bank statement from some bank that you know you don't bank with, you may have questions. But will be the name of the bank, will be their address, so on. And then you should see member of the FDIC. Okay? I think that's like the Federal Depository Insurance Commission. That's just a shot in the dark. My memory's not good on that acronym. But make sure it does have FDIC. If you're working at a bank and does not have FDIC, it's not insured, and if the bank goes under, you lose all your money. At least you're protected up to, I think last time I saw it was $250,000. So make sure it's FDIC. You should see your business or your name and good old-fashioned address and statement closing and the account number. Now remember, as an accountant, you are not allowed to have this sensitive information of the account number to be released to any outside parties. This is just another way to verify that we got the right bank account, especially if the company has multiple bank accounts. So you don't want to be reconciling the wrong bank account. So make sure you have that and get it correct. Now, from there, you'll have the balance. This is the balance of the last statement. This should match, again, the book for last month. we should have at least know what the differences are. And if you're doing QuickBooks and you're doing reconciliation on the software, this should be the amount that is shown. Okay? This is the deposits. We have 20 deposits according to this one, and this is the amount. Now, don't get confused to what the bank puts as deposits. The bank will mark them as credits. We know deposits for our cash account is a debit. Okay? The reason why banks will do credits or deposits is that when you open a bank account, that's basically a liability to the bank. They owe you money. So they call it credits. But because, again, remember, liability increases by a credit. That's why they call it credits on the bank statement. Same thing, that's why they call checks debits. Because a liability lowers by a debit. That's why it's always confusing, so don't pay attention to this on the bank statement. That does not say that the account is going to be a credit when you deal with journal entries. Okay? I know we're not dealing with journal entries, but I'm just letting you know, because in 2301, you don't do this. Alright. So, we do have an ending balance, and this is what we're going to be using for bank reconciliation. This is the bank's ending, which will not match up to the book. Okay? If it matches up to the book, then yay, nothing bad happened, everything's clear. But we already know that's not going to be the case. And of course, you're going to have the legend. Down here, usually with bank statements, it's on the last page, but I will tell you in case they have to use the acronym, like there's our EFT, there's a debit memo, which, as you can see, it actually says deducted from accounts. So this means some money went out, time for a fee. There's our NSF check. And of course, these are all of our deposits. So usually this EFT is probably a collection we didn't know of. We want to check on it. Okay? Again, the reason why this is important, I'll say this, is if you understand this, do it for your own bank accounts. Again, I told you in class, we went over this. Fraudsters are getting more and more smarter. So they will spoof locations with the bank to put it where you're at, and they'll start doing smaller amounts. They won't go like on a spending spree. They want to make sure it mimics your bank account as much as possible. So make sure that you do reconcile every now and then as just a double check. Again, I'm stuck at home, might as well practice. So, and this dotted line, you're seeing this means the statement was longer, but for the book, it couldn't show everything. If y'all remember that right, when I went over the workout problems and in the homework video, we're going to do a comparison. So we will have all this information. Again, you get to see how bookkeepers really work. Yay! I know you're so thrilled. Alright, so we're going to work on this example. And this is the information we're going to use. Information based on the bank statement. Again, like I said, that EFT payment was probably a collection. So it was. From customer on account on April 9th. And for that amount, we have an NSF check of $425. We have our credit card fees from the bank of $120. And then, of course, the service charge of 30. Information related from the accounting records. We know the cash balance in our book, or basically the records, was $11,709.45. Can't forget the cents. We made a deposit on April 30th of $2,201 that we did not see on the bank statement. We also had some checks that we did not see on the comparison. So, again, you compare and contrast. Here we just made it a little bit, this is what it is. And then, apparently we do have an error. Okay? So we're going to go step by step. Okay? First off, here's your bank reconciliation. Now, there's different formats to this. I'm going to do it side by side. It's a little bit easier to put on screen. But, you may have top bottom. If it's top bottom, what's on top is usually always the bank. What's on bottom is the book. I like side by side. It's just a little bit easier to comparison. Okay? So first off, left side will always have the bank, and right side will have the book. And we need the balances. These are again the ending balance of the month for these items. So bank, you can find on bank statement. Book, we would actually look in the records, but it was given to us. The first item right here. So there's the $15,907. And we're like from the bank statement. Book was information that was given to us, or that we can actually go look in our accounting records and find the ending balance. Okay. Next, let's focus on the bank statement. Bank statement we can see. And here, we know these are recorded from the bank statement. So we know if we take a guess, bank has already recorded. That means the book has not. That's really what's going on with these comparisons. Who recorded it and who hasn't. Whoever hasn't recorded is where we need to put the information on the bank reconciliation. So, since the bank has recorded all these transactions, who hasn't recorded it? Let's take a wild shot at that. The bank's recorded it, who hasn't? Or which side am I going to put it on? That's alright. Yeah. The book. So all these are coming from the bank statement that we know are all going to fall under the right side, the book side. So they're going to affect the balance in one way. So again, we have a collection. So this naturally increased our bank account. So this increased our bank account in the bank. Will it add or subtract to the book? That's right. Oops. That's giving away something. What? There's the. Alright. So, if it increased in the bank, the cash in the bank, will it increase the cash balance on the book? Will it do the same? That's the question. And the answer is yes. We know it's not increase cash in the bank. It should increase cash in the book. So, we're comparing a bank statement, and we know that a collection is good customer paid us money and increases our cash in the bank. This will be an increase on the books. Okay. I don't see any interest. Do you see interest? Alright. Next, the bank actually tells us that there is an NSF check. Okay? So this one I kind of already gave away, but since this we know is going to lower our cash in the bank, it's going to do exactly the same on the books. So the bank has already recorded it, it's right down the statement. The book has not. So there's our deduction on the NSF check. On the debit and credit card fees, are we going to add them to the book, or are we going to deduct them from the book? Which one should we fall under? Good, Brandy. Yeah, it's a deduction. Again, on the bank statement, it does show us that it lowers our cash. So, of course, here, you gotta lower the cash. And the last bit of information that we can actually pick up from the bank statement that they've done that we haven't recorded is, of course, the bank service charges. Which I'm just going to finish that off because, again, that's just like the fees. Okay? So far, that's what we pulled from the bank statement of items that we know the bank recorded and the book hasn't. Okay? Now, we're going to look at stuff that the book has recorded and the bank hasn't. And this is also going to fall either as an add or a deduct. So I think that will be down. So, yep. Deduct is somewhere around here. There we go. There's deduct. Alright. So we have add and deduct also. Again, we're going to look at the nature of the transaction or the difference. And does it increase cash or decrease cash? Again, the common ones are probably a deposit or a check. So, first item that we see is, again, a deposit that was made on April 30th. So, we know deposits, again, will increase our cash. So, since it's going to increase cash, are we going to add it to the bank or deduct from the bank? Alright. Now, anytime it's a deposit in transit, which again is very easy to spot, usually always at the end of the month, since we know it's going to increase cash, like it increased the cash account on the books, it's going to do the same in the bank. It's going to increase it, so we need to add it. Now, the next part is, of course, checks. We already know checks on the book will decrease our cash, which means it needs to also decrease on the bank. But again, once these actually clear, they're going to be decreasing our bank accounts. Normally, you like to list them, okay? Some companies do a total. That's just, no, don't do that. QuickBooks is not going to let you do that. QuickBooks is going to tell you clear each individual check. So, getting the pattern to basically list it. This also helps us. If somebody's going to come behind you, and look at your bank reconciliation. They're going to go, hey, this check hasn't cleared in 3 months. I may need to call that person to see if I need to reissue a check to them. Or hopefully nothing bad has happened to them. Sometimes if you're really good friends with the supplier, they're not cashing a check, you may do a welfare check. Basically check on their well-being. You'd be surprised how many times that actually helps people. Basically once you develop a kinship with some. Alright. Last item that we have, this last bullet point that we see as a difference is further review of the bank statement and cash register or check register. So basically we're reviewing both sides. The person found a check to be number 443 was a payment to a supplier. Okay? So we know it's being paid as correctly drawn from the bank of $1,226. Okay? So we have to picture what's going on. The bank correctly drawn, but we recorded in the books for $1,262. Okay. So we have to figure out what happened with cash. We either overstated or understated our expense. And this will let us know, oh, we may need to fix our cash. So, first off, let's find a difference. 1,262. Okay. Oops. 62 minus 166. So we have a difference about $36. Okay. So, I can show you a really cool little trick. I'm going to show a trick of finding where this $36 falls under. Yeah, I know y'all do. I don't have to type it. Alright. Now, there's two ways to do an error. One, you can go the long route, which is actually looking at the over and under. Here, since it's a check, which means I recorded more of a withdrawal on this expense. So I would actually have to add the cash back. But there's another way. This is what's called out bank reconciliation. If I can't figure out if I should add or deduct this amount or an error. I'll show you this with this example. First off, this is my last item. I already know the bank has correctly drawn. That means I have nothing else to do with the bank side. So I can find the total over here. So, first, let's add the deposits back to the balance to increase the cash. And then, of course, I'm going to decrease the outstanding checks. So, I know my balance currently should be, adjusted balance, $12,204.85. Okay? I look over here on the book side. Okay? This side we know we have the error. We'll either figure out if we should deduct or add. Here's a nifty little trick. I take the balance, and I do like we usually do. So, 11,709.45. Add in the collectible, or the collection. And then subtract out the total deductions I do know of. We will find that the balance is a little bit different. Now, for this balance, to make it to where the bank is? Am I going to have to increase or decrease this balance? Am I going to have to add something to it, or am I going to have to subtract something to it? Okay? Now I'm going to have to add, since I know the only other item I have is this $36. Well, since I got it on a calculator, let's add $36. It does, it balances. They're going to be the same. So this tells me on my bank reconciliation that my error is addition. This will help you out a little bit on the exam. Okay? You do know that you have an error, and only the error is the trouble. Okay? Also works with only one error, but multiple errors will still basically tell you that, hey, I need to do something here. But, again, if you want to do it as the accounting way, again, I do know I have 36. My expense is, again, over withdrawn. It's higher by 36 compared to the bank. So, if I have to lower the expense, basically make a negative of the expense, that would mean I'll have to do the opposite cash, which is add also. But this is a nifty little trick either way. Okay? So, cute little step. Now, your tabler. Because you know you're going to have to use tabler. And this is how I'm going to show you the error also. But, remember this. When we make these adjustments, only the book side will get the adjusting. You cannot change the bank. Bank is the bank. It's a different company. We can only control our books. So when we do these, again, did them kind of like this. I wish I did, but oh well. First one, collection. Collection in itself. You already know the cash. We've reconciled correctly. We know how cash is affected. Of course, if we're going to add cash, cash is going to increase. Going to deduct, cash is going to basically will go down. The only problem is remembering the second part of these accounts. So, when it's an EFT, it's going to pretty much favor accounts receivable. The only time it'll be notes receivable will be if it specifically tells us it's from a note. Okay? That's the only difference between those two accounts. But, because it's a payment, cash did increase, accounts receivable will decrease due to the collection. Okay? Now, the book error. Here, this book error was dealing with suppliers. Okay? Only time we have a supplier is when we pretty much owe the money. So we're going to deal with accounts payable in this example, but be careful. We can have errors everywhere. Typically, if it's a check, it's probably going to be overdrawn. So we're going to have to add cash. But it could be an expense, it could be office expense. It could be from an asset, office supplies. So make sure on the exam, or the homework, or the quiz, to definitely read where it came from. Okay? This time it just came from the supplier. So, since it's basically overstating the liability, we paid them more money on the books than we should have, we would actually increase the payable. We still owe them that $36. We can get away from that. The vendor's going to be mad about that. So, for this instance, on this error, we do increase the liability. The asset, or cash, is increasing. Errors are going to be the one part that's going to get you. But remember, just one item. You know everything else is actually going, it's partial credit. So, yeah, I know I'm trying to ease your mind a little bit if you're panicking about the exam, but errors are going to be probably the particular one that's going to get you. Maybe on this side. Hopefully you'll be able to catch it for the bank reconciliation. Again, an error is just the bank has done it this way, but we recorded it different on the book. So it's always the difference between the bank and the book on errors. Okay? And I definitely know that you're going to deal with errors on I think the last workout problem on the homework, which again is in the homework video. Okay. Next is the NSF check. Now, NSF checks, we already decreased it right here. So that does mean that cash is going to decrease. This also means that somebody owes us money and didn't really pay. So of course, this is going to hit accounts receivable. We still expect this cash to be received from this customer. So, it's going to increase to whoever is responsible. And the last one is bank charges expense. Both actually combine these two. So you can combine the two. You can keep them separate if you want to. But I would probably suggest to go ahead and combine them as their fees for the homework, just in case so you don't get anything wrong. But bank charges, again, we know this part. That's part of our bank reconciliation, cash went down. And since this is bank charges, it is an expense, it'll be known as bank charge expense. Okay? That's our bank reconciliation. I will come back to this concept check a little bit, so don't worry too much. Yes, we'll go through this when we have the time. I want to go ahead and hit the next part, because I know that probably y'all got questions on this. I'm going to hit both of these at the same time. Okay? So, cash budget. This is the other one that's going to pop up for y'all. And the cash budget in itself is dealing with cash management. And right now, most companies will fail due to cash management issues. Even though that these seem common sense, sometimes they are, there can be things that are unpredictable, like this pandemic. Again, they're trying to manage their cash as best as possible, but things are going on. So, I'm going to go ahead and highlight these. Lots of red. Alright, first off, we do have to increase the speed of receivable collection. For cash management, you want to make sure customers pay quickly. Again, discounts are going to be the best incentive. But we need customers to pay quickly again so you can use those funds. We want that cycle to turn over very fast. Some companies, if it's not turning over fast enough, they may actually change their collection period from 30 to 15 days. Be careful to do this, because you can make customers mad, and you can alienate them. So, that's just a suggestion the book gives. One thing, you don't want to anger your customers. You may be stuck in a rock and a hard place. So you may increase the discount to them. Again, pay early. They want also good cash management is keep inventory levels low. Okay? Make sure you only have inventory that you need, but be careful again. If you put too much, money's tied up in the inventory until you sell it, and you have the increased cost to store it. But if you have too little, you may run it into shortages and could lose sales. Now, this does not go with a pandemic, like everybody going after the TP, toilet paper. Companies have high amount of inventory for it. It's just, that's what happens. This is known as a run on a particular item. There's nothing to prepare it for. All you can do is prepare to get more inventory and not go overboard on inventory. That's why you see stores that stay empty. They're not going to go overboard because they don't know how long the pandemic is. And if the pandemic ends sometime and they have like too much inventory, again, the cash tied up. So it's kind of like one of those things. I know as consumers, we're kind of like, where is it? At the same time, the only people that you can blame are, of course, the hoarders. And the people that want to gouge it and sell it on eBay. I honestly don't know why this disease made people go buy toilet paper, but people in a psychological effect, they want to be in control of something. That's why people go buy toilet paper. But as you know, the symptoms of COVID, there's nothing going to happen unless your diet is completely on Taco Bell. But either way, now the issue about buying everything during a crisis, that one is poor cash management of the individual. Yes, you're buying all these supplies, but there was no announcement that grocery stores were going to close down. Of course, government's not going to allow a grocery store to close down. Sorry, it won't. So, but when you go buy out and hoard all these items, yeah, it affects other people that cannot get them, that probably need them. For a business, it's not going to affect them too much. Yeah, they're probably going to be losing a little bit of sales, but overall, as soon as the inventory comes in, they take their money back because people did. But what companies are fighting back against is this. You can't return these items. So congratulations on the customers that decided to buy, 10 million rolls of toilet paper. Oh, hey, your stock's growing this life now. Because you can't return them. I ain't going to accept that. But, it is what it is. It's just panic buying. Buy what you need, and that's it. Don't overspend. Because again, if you overspend, and then all of a sudden, your place of business, your workplace closes down, or now all your money's tied up in toilet paper. That's just the thing. Now, again, it's just a psychological effect for people that went panic buying. They buy stuff that they think that they can control, that they know that in a crisis we always buy toilet paper and water. Virus doesn't work on that level. But anyway, that's me being on my soapbox. Next thing that we want to do for proper cash management, we gotta get back on the issue, is monitor payments on liabilities. So again, we want to make sure we can pay our bills. And this is providing timing schedules on paying bills. Again, we do know that certain bills, we have a little bit of leeway, comes in at the beginning of the month, we can basically pay at the end. If we want to, and we can get a discount, we may pay it off early. But there's also issues if you pay off early. You do lose access to that cash, which basically means I could have probably made some more money using that cash and more money at the end, but I decided to pay a bill early and didn't need to. So that money's gone. But if you paid late, which you don't ever want to do, of course that's going to damage your reputation, and that may incur fees. Okay? And also you want to plan the timing for major expenditures. And don't spend money that you don't have. So for machines or any other equipment, you again want to be very good at protecting those assets. And plan to probably do it when you have more money. So you're right now in this crisis, and all of a sudden you want to buy a car. Unless you need that car, and you're buying it just to buy it, or an ATV, you may want to hold off. That's just good cash management. Wait till you have excess, or good savings. Anyway, and of course, cash that just lies around, which is known as idle cash, most companies need to invest that. So invest excess cash into businesses to help improve. Again, don't want anything major unless you can afford a major. A lot of times companies will invest into highly liquid investments or risk-free. But again, this is the problem that happens to a lot of small businesses. Once the owner sees extra money, they spend on themselves and not the business. You want to improve the business first. Okay? Like your kids. Make sure your child's taken care of before you take care of yourself. Okay. So, ways that we can do this is known as a cash budget. Okay? So, with the budget, we want to show, again, how cash is going to flow and pretty much predict, again, sometimes budgets are estimates of what we may need. Okay? So this is, again, just all X's, but this is how they usually are. We're going to start with a beginning cash balance. Then we're going to add in cash money that we should receive. This could be from credit sales, customers that are paying us back, or paying their accounts off, to just cash sales. So, difference between cash sales and credit sales. I know the difference between those. This will tell us how much cash is available for us, or how much we can use. Next, we'll take out our disbursements, basically our expenses. stuff that we're going to pay cash for. This does not mean if we're taking out a loan or any other items that we may are payable that we're not going to pay during this time. We're only looking at what cash is going out. This is like the beginning of a cash flow statement. It's like the baby version of it. Okay? After that, we subtract. This is known as excess or deficiency. Excess, again, means we have more cash over our basic expenses, basic bills, or we need money. Okay? Of available cash over cash distributions. So, the next step we're going to look at is probably financing. If we have a deficiency, or we want to reach an ending cash balance goal, we're probably going to have to borrow money. If somehow we have an excess, and it's good enough to keep that ending cash balance we want, we'll most likely go and make a payment on a loan. These are the repayments. Okay? So, again, these are examples of cash receipts. There are cash sales and collections from customers on credit sales. You may have interest in dividends of money coming in. You could actually have, this is where we plan our expenditures, maybe or basically a sell, probably a sell of investments, fixed assets, or stock. Again, this is all money coming in, only cash. Okay? So you can't take total sales. You have to only take the cash coming in from collections. Okay? Disbursements, again, is any expense. Maybe we projected payments for taxes, dividends, investments, or, to purchase that new fancy fixed asset. Okay? Financing itself, we're going to do any borrowings and repayments as such, probably plus the interest. So, here's our example. So this is Hayes Company. And I'm just going to go through a couple of months, and then I definitely want to do the concept check on it. Okay, the simple one from the book. And if we have time, we'll go back over to the bank reconciliation and do that concept check. In the meantime, y'all can then ask any questions as y'all want while we go through those concept checks. Okay? So again, showing from the example, this shows us that beginning cash balance for quarter one for them was $38,000. Cash receipts, what they collected from customers in quarter one. Basically, this is your accounts receivables being paid, was $168,000. And probably some cash sales. They sold securities for $2,000. And this tells us the total money coming in, total cash coming in, was $170,000. Okay, so this is the cash coming in. So we add the cash we already have in our checking account, or in our book account, basically cash account. And together we figure out that we have $208,000 that we can play with. This is our available cash. Well, first thing that we have to do is, of course, pay our bills, our items. So they actually itemize this. We have inventory. I go purchase inventory. I pay the workers. And then, of course, they have a few other expenses. Notice, it's excluding depreciation. Now, we haven't talked about depreciation too much. Remember, depreciation in itself is not a cash transaction. Don't worry, I don't think there's anything that deals with depreciation. I can't remember off the top of my head, but it's okay. Here, they also have income tax expense. They're assuming that their tax is going to be about $3,000 each quarter. That's their tax payment. Okay? So taking all of these, you subtract from available cash, and this, well, the total, basically, total up, and then we subtract 2, and this is your excess cash. So they have more money. Right now, I think in this example, we wanted to at least have cash balance of $15,000. So here we're over at cash limit. So this amount, ending cash, comes now at the beginning of the quarter. We're going to go through the same process. Notice here, we did not sell any securities. Nothing to do with collections. Add those together. That's going to be our available cash. And then we're on take. Now, they're planning to purchase a truck. Since quarter 2, they're way over now. How much did they want? They went ahead and purchased a truck for $10,000. Again, they're planning their expenditures. So total, all of these is, again, right here, and we subtract the 2. This means that this time, as we're purchasing the truck, we kind of went a little bit under how much cash we actually want to be available. We're at $12,000. They want to be at $15,000. So, we're going to have to borrow $3,000 to stay at $15,000 in cash. Basically, again, that's what they assume that will help cover everything. Well, then, you don't know, but in this example, apparently it does. Quarter 3, we go through the same process. Again, since we only purchased the truck in quarter 2, should be 0 in other quarters. And here, you come out to $22,500. Again, it's above the limit that they want. So, again, they want $15,000. So here, we're going to take the excess and go ahead and knock out this loan. So you go ahead and pay off the loan plus $100 worth of interest. That's why it's $3,100. And then they fall through in the last quarter. So, yeah, 3 minutes till the class is over. What I'm going to do is I'm going to go back over these concept checks on Thursday. Like a little review at the beginning of the video. I'll go through both of these concept checks, the bank reconciliation, and this one. It'll basically just give a refresh again over chapter 5, and then we'll go ahead and jump into chapter 6. I'm going to go ahead and give this time for the remaining few minutes. Any questions regarding any part of this chapter? And also, any questions regarding anything that's going on with the college or any questions you have at all? We can go ahead and answer a few of those right now. Alright, this is, so far on the school actually being open, that will probably fall in line with the school districts, which I think is going to be May, mid-May, probably when they open. I know they're waiving off all rental fees and stuff, so for that, just keep in contact with the library. Make sure that you send an email to the library. On the toilet paper, that is, again, like psychological effects in a crisis. You want a certain part of controllability. That's what people do. And they probably just saw someone doing it, and it just basically monkey see, monkey do. Okay? Again, be comfortable. That's what people want. It's a comfortability item of toilet paper. For you, Brandy, with questions, again, we can always set a tutor time. I can go on Zoom or one of those. Y'all need extra tutoring. Okay? And I don't know how the tutoring situation is going. It probably isn't, but again, we can set up meetings and try to help you over. Again, you're going to have this lecture video that's going to be posted on YouTube. That is going to be long. Sorry about that. But again, you can cut to the pieces you know since we went over them. And then you do have the homework videos. And of course, again, we can always set up times to help you out to get you going and understand. Yeah, I'm going to post this on that YouTube channel because apparently it's recording straight to my computer. And then I'm going to post this on D2L, just like I'm doing with the homework videos. Okay? So, they're still going to flow the same way, because now I know that the recordings are going on my computer, so I should have the video file. They're just not going to be, like, broken up into individual parts, because that's how these lectures are going. But at least you have something. Alright, you good? Yeah. Again, any other questions? No. It's not going to count as an absence. I do want y'all to actually be here just in case you do have questions. So, that you do have an idea what's going on, but you are not required to be here. But, again, just in case, this is the in-case part. This is why I check every now and have the roster up, is just in case the college wants to know who actually showed up for these. Because again, they're going to take all the statistics and everything from you also. Yes, all the assignments are up on Wiley. You can go ahead and do those. The homework videos for 5, 6, and 7. 7 on D2L now are up. So you can go through those. Again, if you have questions, one, y'all should be signed up for Remind. Definitely send me messages through that. You can do that. Instant message, I'll get it. Looks like a nice little cloud on my phone. So I will see those. And again, I'm going to try and send out reminders either today to remind you that there is a class going on. Because again, on exam days, there's no class. So there's nothing to lecture you on. The exams take that time to take the test. But again, I'm going to get y'all through this. Okay? That's my job, to get you through it, to get y'all to the grade that you want. I'll give you the grade. So I'll put the work in. Okay? Any other questions or concerns? I'm going to go ahead and stop this.